This Fed move could cost you $4,200 a year. The Fed's decision is looming, and it could lead to a rate hike, increasing borrowing costs and affecting mortgage rates, ultimately hitting your wallet. You'll learn how this impacts your finances and what you can do about it. A rate hike would increase mortgage rates, making it more expensive to buy or refinance a home. For example, a $300,000 mortgage at 4% interest would cost $1,432 per month. But at 5%, that jumps to $1,610, an extra $178 per month. And with the average American household having $174,000 in mortgage debt, this could add up quickly. Historically, every 1% increase in mortgage rates has led to a 10% decrease in home sales. In fact, back in 2006, when mortgage rates rose from 5.8% to 6.4%, home sales plummeted by 15%. Furthermore, a second-order effect of higher mortgage rates is that it could lead to a decrease in home renovations, as homeowners may be less likely to take on new debt for renovations. For instance, a homeowner who was planning to take out a $50,000 home equity loan at 6% interest may now be deterred by the higher interest rate, potentially leading to a decrease in demand for home improvement services. Additionally, consider the case of a couple, John and Emily, who were planning to buy a $400,000 home with a 20% down payment. With a 4% mortgage rate, their monthly payment would be $1,955. But with a 5% rate, that payment would increase to $2,147, an extra $192 per month. So, what does this mean for the housing market? We'll explore that next. But the part that surprised me most is what this does to your credit card debt and how it could lead to a debt crisis. For example, if you're carrying a balance on your credit card, a rate hike could increase your minimum payment, making it harder to pay off your debt. We'll dive into the specifics of how this works and what you can do to avoid getting caught in the debt trap, including strategies for paying off high-interest debt and building an emergency fund. In the next section, we'll reveal how a rate hike can turn a manageable credit card balance into a financial nightmare. With a rate hike, credit card interest rates will also increase, making it more expensive to carry debt. The average American has $4,293 in credit card debt, and with an average interest rate of 16.4%, that's $704 in interest per year. But if rates rise by 1%, that interest payment jumps to $814, an extra $110 per year. And with credit card debt already at record highs, this could lead to a debt crisis. For example, in 2008, when credit card debt peaked at $1.02 trillion, the subsequent recession led to a 10% decrease in consumer spending. Additionally, a common misconception is that credit card debt is only a problem for individuals with poor credit, but in reality, even those with good credit can be affected by higher interest rates. A second-order effect of higher credit card interest rates is that it could lead to a decrease in consumer spending, as individuals may be less likely to make purchases if they know they'll be charged higher interest rates. For instance, a study by the Federal Reserve found that a 1% increase in credit card interest rates can lead to a 2% decrease in consumer spending. Furthermore, consider the case of a person with a $2,000 credit card balance at 18% interest, who is making minimum payments of $50 per month. With a 1% rate hike, their minimum payment would increase to $55 per month, and it would take them 5 years to pay off the balance, compared to 4 years at the original interest rate. So, how can you avoid getting caught in this debt trap? We'll explore that next. But what if I told you there's a way to actually benefit from a rate hike, and how you can position yourself to take advantage of the opportunities it presents? We'll reveal the strategies for turning a rate hike into a financial win, including how to earn higher interest on your savings and how to capitalize on a stronger dollar. In the next section, we'll show you how to make a rate hike work in your favor, with a real-life example of how someone turned a rate hike into a $1,000 per year windfall. While a rate hike may seem like all bad news, there are ways to benefit from it. For example, if you have a high-yield savings account, you could see your interest earnings increase. According to Bankrate, the average high-yield savings account has a 1.5% interest rate, but some accounts are offering up to 2.5%. So, if you have $10,000 in a high-yield savings account, you could earn an extra $100 per year in interest. And with some accounts offering up to 5% interest, the potential earnings are significant. Additionally, a rate hike could lead to a stronger dollar, making imports cheaper and increasing consumer purchasing power. For instance, if the dollar appreciates by 10% against the euro, that could lead to a 5% decrease in import prices. Historically, a stronger dollar has also led to an increase in foreign investment, as foreign investors become more confident in the U.S. economy. Furthermore, consider the case of a retiree who is living off the interest from their savings account. With a 1% increase in interest rates, they could see their annual interest earnings increase by $500, providing a welcome boost to their retirement income. So, how can you position yourself to take advantage of these benefits? We'll summarize that in the outro. In summary, the Fed's rate hike could cost you $4,200 per year, but there are ways to mitigate that impact. Consider refinancing your mortgage, paying off high-interest debt, and taking advantage of high-yield savings accounts. To take action, start by reviewing your budget and identifying areas where you can cut back on expenses. Then, consider consolidating your debt into a lower-interest loan or credit card, and make a plan to pay off your debt as quickly as possible. Finally, take advantage of high-yield savings accounts and consider investing in a diversified portfolio to earn higher returns. As a next step, take 10 minutes to review your finances and make a plan to adjust to the potential rate hike. This is for education, not financial advice. Talk to a fiduciary for your situation. If this changed how you think about the Fed's decision, hit subscribe. I break down one of these every week.